In recent years, Goldman Sachs, one of the most respected names of Wall Street, has faced some significant challenges. We will dive into the reason behind why this banking giant could be in serious trouble. Goldman Sachs, known for its financial prowess, found itself in the top spot due to its foray into consumers lending. Some experts have labeled this move as both a strategic and financial failure. At the outset, Goldman Sachs embarked on a journey with a vision of building a highly profitable consumer lending business. They were confident in their abilities and stated, "We think we can build a very profitable business." The financial world was watching with anticipation. However, as time passed, Goldman's ambition seemed to get the better of them. The rapid expansion in the consumer lending space led to issues. They admitted that they did too much. This aggressive approach raised concern. Consumer lending was never the primary revenue driver for Goldman Sachs, accounting for just about 3% of their total revenue. While not a disaster in financial terms, it did tarnish their reputation. This situation begged the question, did flawed decision-making play a role? When Goldman Sachs announced its shift into the consumer's lending arena, it made headlines. The idea of a traditional Wall Street giant disrupting the financial space with new technology and talent was intriguing. Everyone was watching closely. The financial world was captivated by Goldman Sachs' bold move. Other consumer lenders and big banks took notice and cared deeply about the outcome. The idea of a financial powerhouse going from Wall Street to Main Street was indeed fascinating. In the year 2016, Goldman Sachs, primarily known for its dominance in the corporate and investment banking world, decided to venture into consumer finance. They're marking their entry into the personal finance sector. Goldman Sachs rolled out personal loans, a product that raised eyebrows across the financial industry. Many traditional consumer banks perceived as Goldman's reputation and resources could disrupt the market. While the emergence of fintech startup offering personal loans was already a point of concern for traditional banks, Goldman Sachs posed a unique challenge. Their foray into the credit card space was seen as a significant risk. In a world where banks were primarily worried about nimble fintech competitors, Goldman Sachs, with its vast resource and expertise, stood out as a formidable contender. The investing community, however, held reservation. A few believed that a traditional investment bank could successfully navigate the intricacies of the consumer finance world. Nevertheless, there was widespread fascination with Goldman's ambitious move. Goldman Sachs didn't embark on this journey blindly. They meticulously built their consumer business from the ground up. To do so, they tapped into the diverse pool of talent. The team they assembled included seasoned executives from the consumer lending sector, individuals with experience in the tech industry, and experts from within their own bank. Their strategic mix of expertise from various fields aimed to ensure that Goldman Sachs had the knowledge and skills required to thrive in the consumer financing area. This blend of talents was a key factor in the intrigue surrounding Goldman's expansion. One advantage that Goldman Sachs proudly touted over other consumer banks with decades of experience in the field was its technological prowess. Goldman had a track record of excellence in algorithm trading, risk management, and digital distribution. This strength gave them a competitive edge when entering the consumer finance market. Their ability to leverage technology for efficiency and precision was a defining feature of their approach. In 2019, Goldman Sachs made a significant splash in the consumer finance arena through a high-profile partnership with Apple. This collaboration resulted in the launch of Apple Card, a credit card that garnered enthusiastic applause upon its unveiling. This move was bold and marked Goldman's entry into the highly competitive space that had long been dominated by retail banks. What follows was a rapid acceleration of Goldman's efforts in consumer lending at an impressive pace. In 2020, Goldman Sachs expanded its consumer finance portfolio with the introduction of Marcus Pay, an installment payment product created in collaborations with JetBlue. This offering allowed consumers to manage their payments conveniently, marking another milestone in Goldman's journey into consumer finance. Goldman Sachs further solidified its presence in the consumer finance sector by winning a highly competitive bid for the General Motors credit card. This victory demonstrated their ability to secure substantial partnership in the industry. In 2021, Goldman nearly succeeded in poaching the JetBlue credit card business away from Barclays, a moment that on these strategic moves left no doubt in the minds of industry observers that Goldman Sachs had emerged a formidable player in consumer finance. The financial world began to take them very seriously, recognizing their commitment to this market and their ability to secure valuable partnership. The driving force behind this transformation was David Solomon, who assumed the role of CEO in 2018. During his tenure, Solomon was a strong advocate for Goldman Sachs' push into consumer finance. He firmly believed that the bank needed to fully commit to becoming a significant consumer lender. Commitment to innovation and expansion underscored their determination to evolve from the traditional Wall Street bank into a diversified financial powerhouse, capable of serving consumers and business alike. Despite Goldman Sachs' aggressive push into the consumer finance sector, not everyone within the company agreed with the decision being made. This dissent within the ranks led to the departure of some key executives from the consumer businesses. It was as if the entire endeavor had turned into an elaborate experiment. With the summer of 2021, Goldman Sachs entered into a deal with the home improvement lender GreenSky, despite red flags raised by some partners with the company. Concerns were voiced about the arrangement, particularly regarding indirect access to consumers through contractors, raising questions about the practicality and cost-effectiveness of the partnership. Goldman Sachs shareholders were also growing increasingly frustrated. As time went on, more and more questions arose about the bank's expanding consumer activities. Why were they adding so many consumer-focused initiatives simultaneously? These questions weighed on the minds of the investors and contributed to a sense of uncertainty. The various consumer products introduced by Goldman Sachs came with significant expenses. Building and staffing this new product, along with ensuring compliances with regulatory expectations, incurred substantial costs. These expenses pushed the timeline for the consumer business to reach profitability further into the future. In 2022, the investment banking business at Goldman Sachs slowed down from its record high the previous year. Suddenly, the financial health of business unit with high expenses became a matter of concern, especially if those units weren't making a substantial positive contribution to earnings. This shift in circumstances prompted a closer examination of the consumer-focused diversification effort. As Goldman Sachs navigated its transformation into a diverse financial institution with a significant presence in consumer finance, it faced challenges and internal dissent. The concern of partners, shareholders, and the overall financial landscapes were now becoming part of the narrative. The bank's journey from Wall Street to Main Street was encountering growing pains that needed to be addressed as it sought to find its footing in the consumer finance sector. In the fall of 2022, Goldman Sachs underwent a significant reorganization, segregating a substantial portion of its consumer lending operations into a separate unit. This restructuring shed light onto the true cause of their consumer venture, revealing that it had been bleeding money for a more extended period and in a larger scale than initially anticipated. In response to an interview, Goldman Sachs made a strategic decision to scale back its consumer ambition. This entailed ending talks for a potential new credit card program with partners such as T-Mobile, Hawaiian Airlines, and Expedia. They also halted the issuance of personal loans, paused plans for rolling out a Marcus checking account, and began exploring options to sell GreenSky. Additionally, the bank looked into offloading its partnership with General Motors and Apple. The retreat from consumer lending after just 6 years raised questions about the timing of this decision. Despite the misstep of their consumer venture, it's worth noting that Goldman Sachs accumulated nearly $150 billion in consumer deposits. The bank indicated that it has no intention of discontinuing this aspect of its business. Moreover, there is speculation that Goldman might have achieved success down the road had it not pulled back prematurely. Comparisons were drawn to Morgan Stanley's wealth management strategy, which initially faced criticism but ultimately paid off over time. Some believe that Goldman could have followed a similar path. Well, that's it for now. If you have found this video insightful, don't forget to like the video and subscribe to our channel. Also, feel free to share your thoughts in the comment section below.